Hey everyone, welcome back to the channel. If you haven't subscribed yet, now is the perfect time because we're about to dive into one of the most important dynamics in the silver market that most investors completely overlook. Right now in 2026, something fascinating is happening in the silver market. As prices have soared from around $30 per ounce at the beginning of 2025 to over $74 per ounce today, one major category of silver demand has been collapsing. Jewelry demand for silver is plummeting. In fact, according to the latest data from the Silver Institute and other market analysts, jewelry demand for silver in 2025 declined 9% compared to 2024. More concerning for 2026, forecasts suggest that jewelry demand could decline another 17% this year. That's a catastrophic decline in what used to be a major component of global silver demand. But here's where the story gets really interesting. Despite jewelry demand collapsing, silver prices are soaring. Why? Why would demand decline and prices rise simultaneously? By the end of this video, you're going to understand exactly why jewelry demand is falling as silver prices rise, what this tells us about the market structure and supply constraints, what's happening in different regions, and most importantly, what this dynamic means for where silver prices are headed going forward. Let me start by explaining the basic economics of this situation because it actually makes complete sense when you understand how silver demand works. Silver is consumed in many different ways. There's industrial demand, which includes solar panels, electrical components, data centers, and thousands of other applications. There's investment demand, which is people buying silver bars, coins, and ETFs as a store of value or speculation. Then there's jewelry demand, which is the creation of silver jewelry and decorative items. These different categories of demand have different price sensitivities. Some demand is what economists call inelastic, meaning it doesn't change much regardless of price. For example, if you need silver for a critical industrial application and silver prices double, you probably still need that silver. Your production doesn't stop just because the input cost went up. But jewelry demand is highly elastic. It's very price sensitive. When silver prices go up, people have alternative choices. They can buy gold jewelry instead. They can buy other metals. They can simply delay their jewelry purchases. They can downshift to lower quality or smaller pieces. This elasticity in jewelry demand creates a very interesting dynamic. In 2024 and early 2025, as silver prices were rising, but before the explosive January 2026 move, jewelry demand started to soften. Consumers around the world, particularly in price-sensitive markets like India and China, started to see silver prices rising and made different decisions about their jewelry purchases. In India especially, which is one of the largest jewelry markets in the world, silver is not just a luxury good. It's also a form of wealth storage and inheritance. When silver prices rise too much, Indian consumers reduce their purchases. They might downshift from buying multiple pieces to buying fewer pieces. They might buy thinner jewelry or pieces with less silver content. They might substitute into gold or other metals. The impact is dramatic. According to the Silver Institute's February 2026 forecast, global jewelry demand for silver in 2025 came in at 178 million ounces. That was down 9% from the prior year. But the really concerning part is the 2026 forecast. Silver Institute analysts are projecting that jewelry demand could fall another 17% in 2026, bringing total jewelry demand down to approximately 148 million ounces. That's a massive decline. Think about what that means. In just 2 years, jewelry demand could fall by over 25%. That's a structural shift in how silver is being consumed. Now, you might think to yourself, well, if demand is falling, shouldn't silver prices fall too? And that's a very logical question. The answer reveals something profound about the current silver market structure. What's happening is that the decline in jewelry demand is more than offset by increases in other categories of demand. Investment demand is surging. Physical silver bars and coins are being accumulated at a pace not seen in years. ETFs are seeing large inflows as investors recognize how cheap silver is relative to gold and how tight the physical supply situation has become. Industrial demand is accelerating as solar installations hit all-time highs and EV production explodes. Central banks are accumulating silver as a strategic monetary asset. All of these demand categories are strong and accelerating. The decline in jewelry demand is a rounding error compared to the growth in these other categories. Furthermore, and this is critical, jewelry demand is coming down from a market that has excess supply in some regions. In India, there's a backlog of existing silver inventory. When silver prices were lower, people bought silver jewelry, expecting prices to stay low or go lower. Now that prices have risen dramatically, these people who bought silver jewelry are actually selling it back. This is called scrapping or melting jewelry back down to pure silver. So not only is new jewelry demand declining, but existing jewelry is being melted down and recycled back into the market as investment silver or industrial silver. The net effect is that the decline in jewelry demand is not creating a shortage. Instead, it's creating an additional source of supply as jewelry gets recycled. Let me give you some specific numbers to illustrate this. In India, silver jewelry demand in 2024 was relatively strong. In 2025, as silver prices rose significantly, Indian consumers reduced their jewelry purchases. The decline was noticeable. Then, in early 2026, when silver prices spiked to $121 before crashing back down, Indian consumers who had bought silver jewelry in 2024 and 2025 started melting it down and selling it back to dealers. This recycling created additional supply in the market. The net effect was that India, which had been a consistent buyer of silver jewelry, became a net seller of silver, at least for a period of time. This dynamic, where high prices trigger recycling and reduces new demand, is actually healthy for the overall market. It creates elasticity and prevents prices from spiking too far. China presents a slightly different picture. China has a growing middle class that has increasing purchasing power. However, China's government is also encouraging alternative forms of jewelry, like gold-plated silver items, rather than pure silver jewelry. The reasons for this are partly related to China's desire to secure its own supply of critical materials. The government doesn't want Chinese consumers buying up all the available silver to wear as jewelry. They want that silver available for industrial use, particularly in solar panels and electric vehicles, which are strategic priorities for China. So China has actually been promoting gold-plated silver jewelry, which uses much less silver per piece than traditional pure silver jewelry. This also reduces jewelry demand while maintaining consumer interest in silver-toned jewelry products. In the Western world, including the United States and Europe, jewelry demand for silver has remained relatively stable, but it's from a much smaller base than India or China. Westerners tend to wear gold or platinum jewelry more commonly than silver. Silver jewelry is more of a fashion statement or alternative choice rather than a traditional store of value. So jewelry demand in Western markets is less affected by price changes than it is in India and China. The broader point here is that silver jewelry is a legitimate category of demand, but it's highly price elastic. High prices cause demand to fall. This is actually healthy for the market because it means that as prices rise and demand from jewelry falls, there's room for other uses to take over that supply without creating artificial shortages. However, the fact that jewelry demand is declining despite overall silver prices rising tells us something very important about the other categories of demand. Industrial demand, investment demand, and central bank demand must be absolutely surging to offset the jewelry decline and still push prices higher. This brings us to one of the most important questions in the silver market right now. If jewelry demand, which used to be a stable and large component of demand, is collapsing and prices are still rising, what does that tell us about the tightness of the physical market? The answer is that it tells us the market is incredibly tight. If the only thing happening was jewelry demand falling and industrial demand staying flat, we would expect prices to fall or stay stable. The fact that prices are rising despite jewelry demand falling means that industrial demand and investment demand must be rising even faster than jewelry demand is falling. And indeed, that's exactly what's happening. Investment demand in 2025 was up 20% to 227 million ounces, according to the Silver Institute. That's a 3-year high. Investment demand was strong because investors recognized that silver was undervalued relative to gold, that physical supply was becoming tight, and that the industrial outlook for silver was improving dramatically. This investment demand surge more than made up for the jewelry demand decline and pushed prices higher. In 2026, we would expect investment demand to remain elevated, particularly if the bull market in precious metals continues. Industrial demand is also accelerating. Solar installations in 2025 reached new all-time highs. The International Energy Agency is forecasting that solar capacity could quadruple by 2030. Each gigawatt of solar installation requires millions of ounces of silver. Electric vehicle production is exploding, particularly in China, and each EV requires more silver than a traditional car. AI data centers are being built at an accelerating pace, and each data center requires significant amounts of silver for electrical connectivity and power distribution. All of these trends point toward industrial silver demand accelerating, not decelerating. So the decline in jewelry demand is completely offset by the surge in investment and industrial demand. In fact, the decline in jewelry demand might actually be a net positive for the market because it means there's less price-sensitive demand that could suppress prices. Instead, the marginal buyer at current price levels is industrial or investment demand, which is less price-sensitive and more driven by structural need and strategic considerations. Now let's think about what happens next in this market. The question is whether jewelry demand will stabilize at the lower level or whether it will continue to decline further. My analysis suggests that jewelry demand will likely stabilize around current levels or perhaps decline slightly more, but then stabilize. Here's why. At current prices around $74 per ounce, silver jewelry is not dirt cheap, but it's not prohibitively expensive either. It's actually still quite accessible for consumers. If silver prices were to fall back to $50 to $60 per ounce, we might see a rebound in jewelry demand. Consumers who held off buying at $100 per ounce might jump back in at $60. But if silver prices continue to rise toward $100 to $150 per ounce, we might see further declines in jewelry demand, particularly in price-sensitive markets like India. However, I don't think the decline in jewelry demand will materially impact silver prices going forward because the other demand categories are so strong. Industrial demand and investment demand are structural and not price-sensitive in the same way jewelry demand is. Even if jewelry demand fell another 20 or 30%, the loss would be easily offset by continued growth in industrial and investment demand. In fact, the decline in jewelry demand actually creates upside for prices because it removes a ceiling on how high prices can go. At $30 per ounce, jewelry demand would have been robust and would have constrained prices as demand elasticity increased. At $100 per ounce, jewelry demand is minimal, which means prices can move higher without hitting demand resistance from jewelry consumers. Let's talk about what this dynamic means for silver prices going forward. The removal of jewelry demand as a constraint actually supports higher silver prices. The structural deficit in silver supply will be filled primarily by investment buying and industrial buying, both of which are less price-sensitive than jewelry demand. The shortage of physical silver will drive industrial buyers to bid higher prices to secure supply. Investment demand will remain strong because investors recognize the value opportunity and the structural bull case for silver. Central banks will continue to accumulate. All of these factors support higher silver prices despite the decline in jewelry demand. My base case scenario for silver prices over the next 12 to 24 months looks like this. In the near term, through spring and early summer of 2026, silver consolidates in the $70 to $85 range. During this period, jewelry demand remains soft as prices are still elevated. Investment demand remains strong as the bull thesis plays out. Industrial demand accelerates modestly as the economy grows. By late summer or early fall of 2026, as confidence returns in the precious metals bull market, silver begins to move higher again. By year-end 2026, silver reaches $100 to $110 per ounce. At these prices, jewelry demand might decline slightly more, but not significantly. The impact on overall supply-demand balance would be negligible because investment and industrial demand are so strong. In 2027, if the bull market continues, silver could reach $150 to $200 per ounce. At these prices, jewelry demand would likely be quite depressed, possibly down another 15 to 20% from current levels. But again, the impact on silver prices would be minimal because the structural drivers of the bull market would be intact and accelerating. The key insight here is that the decline in jewelry demand actually removes a constraint on how high silver prices can go. At lower price levels, jewelry demand acts as a price ceiling. At high price levels, the removal of jewelry demand actually supports even higher prices because the marginal demand is from sources that are willing to pay higher prices. This is a subtle but important point that most analysts miss. For investors, the decline in jewelry demand should actually be viewed as bullish for silver prices. It removes a demand category that would otherwise constrain prices and prevents prices from going too high. It means the supply-demand balance for silver is being determined by industrial and investment demand, both of which support higher prices. The structural outlook for silver has never looked better. Jewelry demand declining is a minor negative, but it's vastly outweighed by the positive factors at play. Looking forward, I expect jewelry demand to stabilize around 140 to 160 million ounces annually. It won't go to zero because there will always be people willing to buy silver jewelry at certain price levels, but it won't be a major growth driver for silver demand either. Instead, the growth in silver demand will come from industrial applications, particularly solar and EVs, and from investment demand as investors recognize how valuable silver is at current valuations relative to gold and given the structural supply constraints. The beautiful thing about this market dynamic is that it's self-reinforcing. As jewelry demand falls and prices rise, that opens up room for industrial and investment demand to absorb supply without hitting price resistance from jewelry consumers. As industrial and investment demand absorb supply, prices can continue to rise. Eventually, at some point, prices will reach a level where they stabilize or even decline slightly as investment demand wanes. But we're not there yet. We're in the early innings of a structural bull market in silver driven by industrial demand and supply constraints. In conclusion, the decline in jewelry demand is not something to worry about if you're bullish on silver. It's actually a positive development because it removes a price ceiling and allows silver prices to rise to levels determined by industrial supply-demand balance and investment positioning. The fact that jewelry demand is falling and prices are rising simultaneously tells us that industrial and investment demand are incredibly strong. The structural case for higher silver prices remains intact and is actually strengthened by the removal of jewelry demand as a constraint. Thanks for watching, and I'll see you in the next video.